Hello, everyone. This is Emma Reese of the Better Policy Project. We had a very interesting seminar this morning where we discussed Mariam's latest consumption function estimates for the United States, which was released as a National Bank of Georgia working paper. The link is on our website at www.thebetterpolicyproject.org. You can also find it in the description below. In the seminar, we also discussed a recent presentation by Mervyn, and let's say we've reached different conclusions. If Mervyn is correct, that people in central banks have been infected by these models that presume that inflation expectations are always anchored, our conclusions would be that we need much higher levels of transparency in central banks about how they're thinking about the economies and what kind of models they're building and so on. Because without transparency, it's impossible to have accountability. Without further ado, let's go straight to the video.
Hi, my name is Doug Laxton. I'm from the Better Policy Project, and I have three of my students from the National Bank of Georgia today, Mariam, Tamta, and Sergey. And what we're going to talk about is, are central banks making the same mistakes? And we're referring to advanced economy central banks like the Fed and the ECB and the Bank of England, the G7 countries. So Canada today or yesterday cut the policy rate by 25 basis points. And there's lots of news that other central banks might follow, like the United Kingdom and so on, and the ECB. And the question is, with the increase in the neutral interest rate in the United States, which was around 2.5% for years, still is around 2.5% in the March dot plot of the Fed. If the neutral interest rate were to be 4%, that would be consistent with interest rates not being high enough to contain these inflationary forces that we're observing. And so we're very happy to have Mariam here today from the National Bank of Georgia, who has just completed a working paper on U.S. Consumption functions. And the basic idea behind that working paper is that when one controls for the effects of COVID, it obviously distorted the consumption numbers because people couldn't consume what they wanted to consume. There was an increase in precautionary saving and so on. And that, according to this work, explains now that COVID is over and we have this big increase in household wealth, that has been what's been fueling consumption in the US. And of course, if asset prices stay high, there's nothing really to stop consumption from remaining strong and so on. So, Mariam, maybe you could give us a brief view about your work on consumption and so on, and then we can move on from there.
Yeah, with pleasure, Doug. Thanks. As Doug mentioned, we just published, our paper yesterday, and I'm happy to share this with you as well. By the way, we have shared it on different platforms already. So the paper is about very interesting topics nowadays, about consumption that explains a lot of things in the US economy nowadays. It explains particularly why we see some demand side pressures and inflation. Specifically, we analyze why consumption was distorted during the pandemic period. By the way, I should mention that the consumption functions in general are one of those rare macro relationships that perfectly fit. But this was the fact before the pandemic. After pandemic started, there was some disruptions. However, once we incorporated some factors, pandemic-related factors, then consumption functions still started fitting again. Why it's important for us? Because it helps us to explain a lot of things nowadays. Why we see still strong consumption, and that's why we don't see recession in the United States. The major forces behind the consumption is the net wealth, solid household balance sheets. And what I mean is the net wealth there. And what drives this massive net wealth in the United States, it's very well analyzed in our paper. Basically, the key reason behind this is what we see at the stock market. I mean, the upsurge in asset prices, which still keeps going up. And the key point here is what drives these asset prices. If we believe that the neutral is high in the United States, this means that this partly validates these high asset prices in the United States. And if we believe that asset prices will keep going up, then we should expect that net wealth will still be solid, and it will be translated into the stronger consumption, which will in turn further exacerbate demand-side inflationary pressures in the United States. So this is kind of case that we have also analyzed in our paper, and I think it's really probable from my perspectives what I have just said. Also, in our paper, we analyzed some case B scenarios as well. I should have mentioned that once we are talking about the consumption stuff, we are trying to analyze this from the FPAS Mark II perspectives. What I mean under this is that we are incorporating there this uncertainty and nonlinear linkages while policymaking. So you can have a look in our paper, and you will see different case A, case B scenarios, how we look at the consumption and how we think what could happen in terms of consumption dynamics in the United States. So this is very brief from me, and yeah, if you have questions or any comments related to this, I would be happy to hear.
So just to be clear, in the global forecasting school, we analyze what is going on in the world and what central banks are doing and the types of issues they're facing using what we call FPAS Mark II, which is the second generation of forecasting and policy analysis systems that were first created at the Bank of Canada and the Reserve Bank of New Zealand, and then soon spread to many countries. But there are still non-FPAS central banks like the Bank of England and so on. Ben Bernanke gave a nice evaluation of the Bank of England, and many of the recommendations are not only pushing us in the FPAS Mark I direction, but pushing us into the what we think is the state of the art FPAS Mark II, which starts off with these three essential ingredients which distinguish non-FPAS central banks from FPAS central banks. Where is the economy today? What are the underlying forces? And what do policy instruments need to do to achieve inflation and other objectives? The Bank of Canada cut rates by 25 basis points. Maybe they have a crystal ball that's better than our crystal ball. We have somebody now digging into their data because Canada is a very data-rich country, and it should be easy for us to construct measures of sticky price inflation. This is from a recent speech of Mervyn King, where he says we need models in which credibility of a central bank is endogenous to its actions. The assumption that expectations are determined by the target is misleading at best and dangerous. So we agree with this. All of our models incorporate endogenous monetary policy credibility. That's an important way that we think about the data. Now, to draw attention to this, and maybe Sergey has some remarks about this, but you can see the issues by this wonderful chart that they produce in the Bank of England's monetary policy report. This is the last one from May. You look at that US line, which is the projected path for the federal funds rate. And you can see that the terminal point, or the point at the end, is 4%. And so that would be an estimate of the neutral rate for the United States. And that would mean that it is substantially higher than what is in the March dot plot, where they ask the FOMC participants where do they think the Fed funds rate is going to go over the longer term. And that estimate has been revised up ever so slightly, the median estimate from 2.5 to 2.6. So if it were to be the case that the market is right and the Fed is wrong, this could be very serious, because in a world of integrated capital markets, those rates would eventually move up to the US as well. So this is a story that basically all countries could be getting this wrong, and so on. Now, the other part of our story behind case A's is this idea where we look at better measures of underlying inflation, non-traded sticky price inflation. And the problem is that for some countries, like the UK and Euro area, it's difficult to get the source data to construct it, and so on. Canada is different. So Canada has the same story going on there. Service price inflation is still high, not as high as it is in these countries. So if you look at year on year service price inflation, it's around 4 in the Euro area and US, so well above the target of 2%. And it's 6 in the UK. So maybe, Sergey, you could provide some perspective, because we had problems getting data in the UK. But Sergey, can you tell me what your interpretation, how worrisome is this 6% year-on-year CPI inflation measure for services in the UK?
Thanks, Doug. I think you touched very important points. I would say the critical points, which has very direct consequences for the monetary policy. First was obviously the estimate of the neutral rate, that the market expectations in general, also how we think about it, and how Larry Summers had the comments about it, is that it's significantly higher than what are the current estimates of Fed, for example. And this is really worrisome, because if we truly have higher neutral rate, it has very direct consequences for monetary policy, because then monetary policy stance, current stance, might not be tight enough to fully mitigate these inflationary risks and pressures that we see. And this also directly connects to what we see in terms of service prices, which you also mentioned that is a good measure or good proxy of our non-traded sticky prices, or the underlying inflation measure that we favor because of the way we develop this measure in Georgia as well as in Armenia. And my perspective is that despite the fact that the headline inflations are coming down, for example, in UK, it's already at 2.3%, which is really close to target. We should not be so optimistic about the fact that the fight with inflation will be over soon, because this underlying measure, the service price inflation, is still running significantly above the target in each country, and especially in UK, which is in which it's around 6%. This means that these underlying inflationary pressures are quite significant and still present there. So for the monetary policy, it means that the central banks might need to have tighter policy, or I would say it's highly likely that central banks will need to have tighter policy for longer to actually mitigate these inflationary risks and pressures.
Okay, good. So the other thing, we had a seminar the Charles Goodhart Hour on Tuesday of this week. They're about to release a video on it. But one of the things that we talked about in that seminar were views by Mervyn King, and where he makes comments about how central banks have messed up during COVID by basically relying upon these models that presume that inflation expectations are anchored and so on. This followed on remarks of an interview that he gave some time ago, where he made the same remarks that central banks have been infected by these models in the profession, these simple toy models and so on. And in that interview with Charles Goodhart, we made the point that we disagree with King in the sense that if they were infected by the profession and these silly little models that presume that expectations are anchored, then obviously there should be much higher levels of transparency and accountability in central banks. So King didn't draw that conclusion. He simply just blamed it on the profession, and then concluded that we need models in which the credibility of the central bank is endogenous to its actions. And we agree with that. We've actually been developing models with endogenous monetary policy credibility right since the beginning of FPAS Mark I central banks at the Bank of Canada. So at the Better Policy Project, we've created a special page in honor of Lord King that has a list of reading material that goes back to 1993 and so on. And of course, all of our standard models at the Global Forecasting School, endogenous credibility features very prominently. So stay tuned for more updates. This is Doug Laxton and Sergey and Mariam signing off from the Better Policy Project.